Hi, Claire here from Pitt News Magazine. And okay, real talk? I was pacing my apartment for 10 solid minutes before recording this intro. Why? Because this week's episode is about options, and I called Aiden Gray for help. Yep, the Aiden Gray. Pitt News star writer, options wizard, and owner of the world's calmest voice. I was nervous. I basically fangirled mid-trade. But here's the thing. What started as a panic call about a Micron put turned into a full-on strategy shift. We're talking about the power of patience, premium, and the magic of waiting. Ugh, I know. Waiting is the worst. Anyway, Jake and Lena are going to unpack the whole thing. So grab your coffee, or maybe some calming tea, and let's talk about why not trading right away might actually be your smartest move.
Welcome to the deep dive. We sift through different sources to pull out the key stuff, basically giving you the essentials without all the reading.
Exactly. We know you're busy, you want to learn, but you don't have time to sort through mountains of information. You're the learner.
Right. And today, we're diving into options trading, specifically figuring out the best time to sell puts and covered calls.
Yeah, it's a really crucial timing question. We're using 2 Pitt News Magazine articles as our base here.
We are. My Trade Was Perfect Until It Wasn't by Claire Christensen, and then Smarter Trades, Bigger Premiums by Aiden Gray.
And our mission really is to unpack this idea of waiting for the market to actually hit your price before you sell the option.
It sounds a bit backwards almost.
It can seem that way at first, yeah. But there's a solid logic to it we want to explore.
Okay, let's start with Claire's story. She sold a put on Micron, felt pretty smart about it, used a Fibonacci level, the 61.8% one.
Which is a standard technical level trader's watch.
Right, and the delta was low, about 0.12, so low probability of ending in the money. And she got a $75 premium.
So on the surface, seemed okay. Low delta, got some cash up front. Feels like a decent setup.
She thought she was like crushing Fibonacci retracements, as she put it.
Huh, yeah, that confidence.
But then, well, the market did its thing. Micron started dropping against her position.
Exactly. So that initial thrill just poof, turned into nerves. She started second-guessing the whole trade.
That feeling is so familiar for traders, isn't it? That switch from I've got this to uh-oh, what did I do?
Totally. So her instinct was to call someone, get a second opinion. She called Aiden Gray.
Okay, the star writer, brilliant trader guy from Pitt News. Makes sense. He's got loads of options experience.
Yeah, and she even mentions thinking about how to phrase it, wanting to sound like she knew exactly what she was doing with those Fibonaccis.
That's very human, isn't it? That little bit of ego, even when you're asking for help. So she explains her trade, the setup, everything, and Aiden cuts right to it. First question. What was the delta on that put when you sold it?
Right. Focusing on the key metric at the point of sale.
And then immediately follows up with basically, yeah, and the market's pulling back now, isn't it? He'd seen this movie before.
Clearly. Experience lets you see the pattern. The initial delta is one thing, but market movement changes the picture fast.
And here's the kicker question from Aiden, after Claire confirms she'd be fine owning Micron shares at her strike price. He asks, so why sell the put before the price gets there?
Ooh, that's the core of it, isn't it? It seems so simple when he puts it like that.
Right. If you want to buy it at that price, why jump the gun?
Aiden's whole point is wait for the market to actually drop to your price. If it gets there, then sell the put.
And the reason?
Bigger premium.
Yeah.
When the stock price is closer to your strike price or even slightly below it, the put option is worth more. It has more intrinsic value, not just time value.
Okay, so you get paid more for taking on the risk you already decided you were comfortable with.
Exactly.
Yeah.
You're capturing more potential value from the option itself because the market has moved in the direction that makes the put more valuable.
But Claire brings up the obvious concern. Doesn't waiting mean there's a higher chance you'll actually get assigned the shares?
Yeah, totally valid question.
And Aiden's response goes right back to basics. If you're selling a put, you should want the shares at that strike price. That's the foundational idea.
Right. So assignment isn't the bad outcome. It's potentially the intended outcome, or at least one you're prepared for and happy with. If you're not happy owning the shares at that price, you probably shouldn't be selling the put in the first place.
He lays out the trade-off then. Okay, maybe you wait, and the stock never drops to your price. You miss out on that $75 premium Claire got.
Mm-hmm. That's the risk of waiting. You might miss a small gain.
But Aiden asks, if the stock doesn't drop, were you going to buy the shares at the higher price anyway? Probably not, right?
Usually no.
Yeah.
So if you stick to your plan of only wanting the shares at the lower price, missing the small premium isn't a real loss. It's just discipline.
And he contrasts that missed small premium with the alternative. The stress Claire was feeling, managing that losing position, the second-guessing, the anxiety.
Which is worse? Missing a few bucks or that emotional drain and potential for bigger losses if the stock keeps falling. For most people, avoiding the stress is worth more.
It's about trading from a position of strength, waiting for your setup rather than chasing.
Exactly. And this whole logic, this waiting game, Aiden says it applies just the same to covered calls.
Yeah, this was the other light bulb moment for me in the articles.
It's consistent. Wait for the market to come to your desired selling point.
He points out what a lot of people do. They get assigned shares from a put, maybe, and immediately sell a covered call way out of the money.
Just to get some premium flowing, right?
Yeah.
Seems proactive.
Yeah, but the premium is usually tiny and your shares are locked up. If the stock rockets up, you've capped your upside for very little reward.
It's a common trap. You feel like you have to sell a call immediately.
Aiden's advice: wait. Just like with the puts, wait for the stock price to actually rally. Let it climb to a price where you genuinely be happy to sell the shares.
Okay, so let the market do the work of increasing the share price first.
Exactly. And then sell the call option, maybe at the money or even slightly in the money.
So the strike price is at or maybe even a bit below the current higher stock price.
Right. And because the stock has already rallied and the call is closer to the money, the premium you collect is much, much bigger.
That makes sense. The call option has more value now, maybe even intrinsic value if it's in the money.
And the benefits seem clear. You pocket a larger premium, you're likely in the trade for less time, and you don't have that awful feeling if the stock keeps soaring after you sold a cheap call way out there. You sold at a price you were already happy with.
It aligns the call selling with your actual goal, selling the shares at a good profit level, while maximizing the option income along the way. It feels more strategic.
But as both Claire and Aiden admit, the hard part isn't the theory, it's the practice.
It's the waiting.
Yeah. Resisting that urge to just do something, to jump in. It's hard in trading. It's hard in life generally, isn't it?
Absolutely. We're often wired for action, but sometimes inaction, or rather patient waiting, is the smarter action.
They really stress the shift in mindset, though, letting the market come to you, letting it do the heavy lifting to get to your price.
Trading from strength, potentially getting better fills on your option trades because you're selling when there's more interest, maybe tighter spreads, better outcomes potentially.
It's about setting your terms.
Yes. And Aiden leaves us, and you, the listener, with this really sharp question to ask yourself before any trade. Am I selling this put or call because the timing is right or because I'm impatient?
Oof. That's a moment of truth question right there.
It forces you to check your motivation. Is it strategy or is it just restlessness? Fear of missing out.
So wrapping up this deep dive, the big takeaway seems to be the power of patience in selling options.
Yeah. Strategically waiting for the market to hit your price target, whether you're selling a put or a covered call, can potentially lead to bigger premiums.
And maybe just as importantly, less stress. Avoiding that immediate pressure when a trade goes against you from the start.
It also keeps the focus clear. Selling puts aligns with wanting to buy stock at a certain price. Selling calls aligns with wanting to sell stock at a certain price. Waiting reinforces that link.
Which brings us to our final thought for you to chew on. How could bringing more patience, more waiting into your trading approach actually change things for you?
And maybe stepping back even further, where else in your life your decisions could a little more patience, a little more waiting for the right moment actually lead to a better result? Something to think about.
So yeah, turns out the secret to smarter options trading is being a grown-up. Who knew? Big thanks to Aiden for not making me feel like a total newbie, and to Jake and Lena for turning my spiral into an actual strategy. If this episode helped you slow down, or at least made you feel a little less alone in your trading freakouts, go subscribe to Pit News Magazine. It's full of insight, education, and yes, even more of me embarrassing myself in print. Go to pitnews.com to sign up, and remember, don't chase the market, let it come to you. And maybe, don't call Aiden every time you panic. I'm working on that.